And welcome into another edition of the Roundtable. We've changed locations, and Tony Mulvey joins me here, Senior Research Analyst. We thought we were going to have an actual roundtable today, but at the very last minute, we got pushed over here, which is going to be wonderful for the visual that you're about to get. Tony, we're going to talk big picture here, and one of the things that obviously has a lot, this is more like State of Freight plus roundtable. So we're looking at the economy as it is right now, because we've got a great segment coming up tomorrow on Roundtable, which is going to talk a little bit much more in depth about the state of the freight economy. Looking at what we've got right now, just big picture, maybe what is one thing, I know there are a lot of big bad things out there, but what is one thing maybe that's giving you hope right now as far as this economy is concerned?
Well, one, I mean, you look at contract rates, right? That's what we got pulled up here. They haven't seen this downward pressure yet, right? I mean, we've talked about spot rates falling really fast and things like that, but contract rates, I mean, are still really healthy compared to previous years. I mean, look at this gap. I mean, we were about $2.50 a mile last year. We're at $2.95. So, I mean, you're talking, these don't include fuel surcharges and things like that, which me and Donnie just talked about, which are kind of creating a little windfall right now if you're charging at retail and buying rack prices, right? That's one additional windfall that it's wider than it was a year ago. Rates are higher. These bigger carriers it's a strong thing. I mean, you factor that in. Then you also flip it, right? We've talked volume levels declining on the truckload side. Well, on the intermodal side, they're still as strong as they've ever been. So, I mean, it's kind of one of those give and take, especially on the domestic side, where it's kind of one-to-one, not one-to-one, but they are a direct competitor with each other, where you don't need that necessary just now, need it now. It can go on the rails. It's a little cheaper, but, I mean, ultimately, this is still a good sign if you're operating in the contract market.
So if you're looking at this now, obviously we've got a ton of things that are going on in the economy. You've got gas prices that are through the roof and been in unprecedented places that they've been. You've got gas reserves, which are also causing a major problem. You've got supply chain issues all over the place. Shanghai is a big X factor in all of this. So if you could pin it down to maybe one or two things that you're absolutely concerned about right now, what would they be?
I mean, obviously inflation, that's the big one, right? It's kind of run away, basically outpaced what the consumer can handle. I mean, we talked about retail sales, spending, things like that. And if you start digging deep into the spending data, I mean, you're seeing spending increase at gas stations, you're seeing some of the shift as well to restaurants, bars, experiences, airline travel. I mean, I looked at Bank of America's data just a little while ago, and spending month over month in like February on airlines was up 31% month over month. And it was up 8% in March. It's up 2% in April. So, I mean, you're still seeing that growth in that spending, whereas spending that's been going on, so furniture, durable goods, things like that, that's where you're starting to see some slowing growth, right? Or even negative in some cases.
And you've got a chart that kind of shows a little bit of this?
Well, it's not this one, but I mean, it's one that we've talked about before. I mean, Pickett talked about this kind of bad chart. It's a bad chart, right? We'll pull that up. And Daniel talked about it earlier. It's the spot line haul versus contract spread, right? Things were really good in the spot market, right, in 2021. It's been widely known. We talked about spot rates. They were above contract rates. Well, we had this inflection point kind of in mid-March. And now we're at the lowest level we've ever been. I mean, even look back in 2020, right, where we had spot rates just basically bottom out. Contract rates didn't move that much. Well, we're even lower than that now. That's not a good thing if you're playing in the spot market, right? So that's kind of the bad, right? If you're a carrier, somebody operates heavily in the spot market, you look at this thing, you're like, oh, it's not a pretty sight.
Let me jump off a cliff and see if you follow me with this, because we had the story with Allianz earlier about insurance rates and the fact that they have had declining rates in terms of accidents, in terms of lost ships at sea, and that's made insurance rates go down. However, the story reported that with COVID, with Russia-Ukraine, with supply chain issues all over the place, that could make that trend reverse. You talked about middle of March. That's basically, we're talking about those kinds of events. Is that affecting these numbers as well?
I don't know how much it affects these numbers per se, but I mean, we have other data in Sonar that kind of talks about insurance rates that carriers and those here domestically are facing.
Right.
And we're talking about almost 25% increases year over year in those. And that, when you see this, and you factor in that increase, it really squeezes those margins, which really, we've talked about it, and I think tomorrow we're even going to talk about it a little more, kind of this impacts of who gets affected in the beginning of what you would say a freight recession, because you start looking at shipments and bookings coming out of China. I mean, they're down 50% off their peak just a few weeks ago, or a month ago, 2 months ago. I mean, you're talking massive increases or declines in these volume levels that haven't necessarily shown up in volumes here in the US yet. So I mean, that's the key, is those impacts of, say, Shanghai haven't impacted freight volumes here in the US, and we're already seeing that decline.
Yeah. You know, it's often been said that one person's disaster is another person's treasure at the same time. So let's go down that road. In terms of what's going on now, we're seeing downward trajectories in a lot of things. Who should be concerned right now? If you could pick out maybe one or two groups of people, or perhaps an industry that need to be watching what they do, who are they?
I mean, truckload carriers top of mind, right? Again, going back to what we just talked about on the carrier update,
Sure.
Fuel prices are record highs. A lot of the smaller carriers operate in the spot market, right? So they're the ones stuck paying, or they're the ones dealing with this spread, right? There you don't have the benefit of those contract rates that we pulled up before at $2.94. They're paying the line haul rate, or they're basically getting the spot rate from brokers, load boards, things like that. That's obviously declined 26% from their peak. So I mean, they're getting squeezed really hard on all sides. So rates are falling, so revenue declining. We talked about insurance, maintenance, fuel, which are three of their bigger expenses. They're all rising, which really squeezes that. I talked about it a couple weeks ago with an analyst at Future Supply Chain talking about operating ratios. In 2021, that full year average operating ratio was about 96 for these smaller carriers. That was in the best operating conditions we've ever had. I mean, that's what this shows, right? That difference. Well, guess what? Those conditions have flipped. It's really fast. It doesn't take a lot to go from 96 to 100 plus, and you start losing money on those loads.
Yeah. So then let's flip the script then. Again, nobody likes to talk about this, unfortunately, that somebody has to make a lot of money off of somebody else's misfortune. But who's getting the windfall out of this?
Well, I mean, the big one initially is brokers, right? Freight brokers, if you kind of think how they operate, right? They're buying capacity at contract rates and they're trying to sell it to shippers at spot rates. Well, that's how they generate their revenue. Those margins are probably a little healthier when you see this rapid decline. But eventually that all catches up with everybody that's moving freight, and eventually it kind of falls back into the shippers, right? They've been beat up. I don't want to say beat up, I mean, because they've still made tremendous amounts of money based on sales and things, but every single one is talking about transportation costs being a lag on their earnings. Well, guess what? We're starting to see the signs that, hey, maybe those trends are changing, and the shippers will be the beneficiary of lower freight costs. And I mean, Target's CEO made a great statement. He was like, we expect this $1 billion in incremental charge for freight and logistics spend and transportation spend. Well, that may be one of those, hey, I'm going to say it's going to be $1 billion, and if it comes in at 500 million, he looks like a genius, right? And that generates that windfall on earnings. Guess what? Makes their stock price go up. That's ultimately what he cares about, is returning that to shareholders, and that could be what happens.
So it's a bit of a mixed bag, although, again, we've seen a lot of indicators go down at this particular point. Let me put you on the spot just a little bit. Scale of 1 to 10, how worried are you about what could possibly be coming down the road? Are you being pessimistic? Are you being optimistic? With 1 being, things are going to be okay, 10 being, hold on to your hats, we could be in for something.
I'm probably about a 7.
Okay.
So I'm pretty pessimistic. I mean, the key here is the economy. You're seeing signs of the economy slowing down. I mean, look at GDP numbers down 1.4%. I mean, you're talking, it's a pretty big decline. Obviously, net exports and things weighed that down. But I mean, you start looking at some of these consumer trends, and they're pretty alarming. And that's what's been driving the freight market and supply chains. Then you start looking at digging into these company earnings and seeing inventory levels, right? I mean, look at Walmart, up 32%, inventory's up 32%. Target, up 41%. Costco's running at these levels as well. That's concerning because they've over-ordered, right? They're not able to move those inventories, which tells you, one, the consumer's kind of slowing down. They reacted. Well, guess what? Stuff that they've ordered for the summer might not be here. Well, now they're having to deal with inventory, these high inventory levels, bringing in stuff for new seasons, trying to move that into a slowing economy, which ultimately is not necessarily a great thing. Then you have the Fed raising rates. You look at revolving credit, so consumers are starting to kind of, I don't want to say overextend themselves yet, but our credit card utilization number is right about the same as what is pre-pandemic. So we talked about the strong balance sheet throughout the pandemic. Well, we've kind of reversed course. Raising interest rates causes that cost of debt to rise. Becomes more expensive. You overextending themselves and cost of debt rising. It's just not a great outlook.
And we don't see a backdoor to this either, right?
Yeah. No, I mean, the one thing would be the consumer stays strong, but it's really hard. I mean, you're going to have some of these inflationary pressures. Obviously, this is one of them, right? But there's multiple, right? You look at the producer price index, it's like raw materials are way up, things like that. So it's not just their transportation costs that are going into rising consumer prices. It's those raw materials and things like that that's really having an impact.
So as we wrap this up, again, things heading, kind of in a genuinely descending pattern. But if there's one economic indicator that you could perhaps reach it and just flip it so it goes upward, what would that be? Just one.
That's a tough one. I mean, it would actually be flipping it the other way, going down. I mean, obviously the inflation one. I think that's the top of at least my mind, or the credit card utilization showing that, hey, we've seen wages come up. They haven't been able to keep up with inflation. That would be an indicator. Hey, we need to get. I mean, it's going to come down to employers. You've seen layoffs and things like that. But if you could get real wages to at least be positive, right, to outpace that inflation number, where the consumer does have a little more money for discretionary spending, I think that's one area that would be okay. Maybe things won't be so bad, but it hasn't shown up yet.
That's an indirect way that Tony's asking for a raise.
I wouldn't go that far.
Tony, thanks so much for joining us here. Again, we're going to have a special roundtable coming up tomorrow looking at what could possibly happen here with the freight industry over the course of the next year or and a half or so. So stay tuned for that tomorrow. I think we've got almost the entire core of analysts and sonar experts here for that there as well. So that's going to be something to look forward to tomorrow around this time. We'll take a short break and be back to wrap up the rest of our show after this.
The